Hello there, so in today's video I'm going to be talking about a stock, EPR Properties, that has a dividend yield of over 7%. It pays those dividends monthly and I believe it's got room to grow as well in capital, and I'll go through all the numbers at the end of the video in great detail for you. If you're new to the channel, welcome. My name is Andy and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you'll get notified every time I release a new video. And if you enjoy this content and find it useful, please do remember to give it a thumbs up, because that helps the YouTube algorithm, which in turn helps me, and I do appreciate it. So without any further ado, let's be diving straight in. So EPR Properties, if you don't know what EPR Properties is, it's a specialised REIT. I have made so many videos about it. I have a whole playlist of them. So I'll just simply put a link to that up there. If you're not familiar with it, click on the link, watch the playlist, watch some videos, find out all about it. But in short, it is a REIT. A REIT means a real estate investment trust, which means it must pay out 90% of its profits in dividends. It pays out those dividends monthly. It has increased some recently. I believe they're going to be increasing again within the next 12 months. And it also, the stock price has been depressed at the moment, which means there's room for it to go up. So full disclosure at the beginning of the video now, I have bought more of this stock recently. So I'm going to go through the slides today so you can see the recent investor presentation. Then at the end of the video, I'll go through some numbers so you can see what price I bought it at, what price I expect it to go to, what the analysts expect it to go to, and how much I expect to make on this particular investment. Now, before I start, I need to explain I am not a financial advisor, so this is not financial advice. Please do your own due diligence before investing in any stocks and shares. Without that said, let's dive in. So the presentation I'm going to be showing you today is mostly from their 2022 investor presentation. I say mostly from because I will be comparing back to the 2020 investor presentation, because there's an important comparison I want to show you there. We'll also be looking at some charts as well. So as you can see, page 4 of the investor presentation. Don't worry, I'm not going to read you the entire investor presentation. I'm just going to show you highlights of the parts that I thought were important. I will put a link in the description down below to the full investor presentation if you'd like to download it and have a read at your leisure. So the key headline here is really that top part where you see raised the guidance and confirmed investment spending guidance for 2022. So they've raised their FFO, which is funds from operation, which is the important metric if you're following a REIT. So that's the funds from operation has been raised from $4.39 per share to $4.55 per share to $4.50 up to $4.60. So it's confirmed an increase there, and they've also confirmed some spending as well. The other important part here is near the bottom, where they've got no borrowings on their $1 billion unsecured revolving credit facility. Okay, so the important parts as I see it on this slide really are the addressable market size. You can see there's a big addressable market there, so they've got plenty of room to expand. And the second thing there is a lifetime historical outperformance. So the likely return you're going to get, or you would get if you had invested in this stock back in 1997, and how it's performed against the market. You can see there they've beat the REITs index, and you can see they've beat the Russell 1000. So they're better than the average REIT, almost twice as good in fact, and better than the Russell 1000. So I thought we'll have a look at how they compare to the S&P 500 over the same period. And you notice I've got that set to total return there. The orange line is EPR Properties, and you'll see where they've been going to. And you'll see they have dramatically outperformed, the blue line being the S&P 500. So they have indeed dramatically outperformed the S&P 500 over that time frame. Now you will notice a couple of things here. So the first thing I want you to notice is the big drop here in 2020. And if you notice when there was a property price crash in 2008, you'll see they dipped a lot more than the S&P 500 did. However, you'll see they came back a lot stronger as well. And you'll see the same thing is already happening again. So remember that pattern. Just remember that pattern. We will come back to that later. So the experienced economy. EPR Properties, if you watch videos already, you will know what EPR Properties do. They own theatres. Now, you will see I've spoken about that in previous videos where I've said I think they own too many theatres. We're going to go through how many they own and how many they've reduced, because they have been reducing it, so we'll go through that in a moment. But they also have ski resorts, they also have themed hotels and other such things like that. So it's very much into the experience. So for example, play and eat experiences. So one of the things they rent to is the golf, I forget the name of the brand now, don't you hate when that happens? Golf World or whatever it's called, where you basically go and play golf and eat dinner. It's all good fun, you know. So that's the kind of thing that they do there. And you'll see here the dip, and you can see that in 2020 and obviously 2021. I've got to say, this chart surprised me. I thought the dip would have been much bigger given that we had lockdowns throughout 2020 and part of 2021. So the fact that they didn't dip as far as I was expecting, from my point of view, I'm quite pleased about. And so I think we're fairly safe to say they're going to come back stronger than they were before. And if you look at the long-term trend, you can see there how it has been continually increasing. So I do think now COVID is essentially out of the way, for want of a better description, it will be going back to normal. Now, the reason I left this sheet in here was really something I disagree with a little bit. They've put consumer balance sheets remain strong, but how long are the consumer balance sheets going to remain strong for? So they put this in thinking it was a positive. My side of things, I've got to be honest, I think with interest rates increasing, I think it won't be long before you find consumer balance sheets aren't so strong, because interest rates have gone up and I think are probably going to continue to go up. And as they do, that is going to mean people's mortgages go up, people's rents go up, basically the cost of goods go up, and that will in turn mean that people will have less savings and less available to spend. However, if you look back at that previous slide, so we go back to this slide here, you can see the grey areas show recessions. And if you see, there's generally not much of a dip in this sector when there is a recession. So what I'm saying there is, if there's a recession coming, we're in a recession already, then actually it doesn't matter too much with this. This is recession proof, for want of a better description. So now let's look at the portfolio in detail. So this is from the 2022. So this is a current investor presentation. You can see they've added a column, strategic focus, which wasn't there when I last reviewed this particular stock. So I like that, and I like to see that they plan to reduce theatres, and notice they now have 175 properties with 19 operators in theatres. If I just flick that over now to the 2020 slide, so this is a 2020 slide, notice that the properties back in 2020, they had 180 theatre properties with 18 operators, and that made up at that point in time 46% of their portfolio. And if you saw my videos back then, I was saying I hope they reduce that down, get less theatres and more other things. Now if we go back to 2020, there you go. So it now only makes up 41%. They've actually increased the number of operators. Again, I think that's a good thing, because by increasing the number of operators, that spreads your diversity, your risk, if you like, between different companies that are your tenants. So you've now got more tenants rather than having one tenant taking up a bigger portion of your pie, because that's the last thing you'd want. And at the same time, they've reduced the number of properties, albeit only by 5. But obviously the main aim will be to grow the other areas, as you can see on this particular sheet here, where they want to increase the eat and play, they want to increase the attractions, increase the ski, increase the experiential lodging, increase the gaming, increase the fitness and wellness. I forgot to mention, yes, they own fitness clubs as well. They want to increase the cultural. Interesting that they want to decrease the early childhood and educational parts. I don't know the reason why. I'd like to know why they want to do that. It doesn't particularly bother me, because that's not the part that got me really interested in this stock when I first started researching it many moons ago. Okay, so if you want to take a screenshot of that, feel free. Otherwise, the slide will be below, and there it is for 2020. And I'll let you compare the two at your leisure, because some things have increased, some things have decreased. The key thing was at theatres, which I've pointed out now. Portfolio highlights. So the key thing I wanted to point out from this slide really was the stability in occupancy. You'll see there was a slight dip in late 2020, early 21, but it's recovered already, and it's got 97% occupancy, which is absolutely phenomenal. And this is, I can't really express this enough, a very, very well run REIT, in my humble opinion. Financial overview. Key thing to note on this page, in my opinion, is the 1 billion revolver now has a 0 balance. So they no longer need to be having that drawn down. If you've watched my previous videos, we've been tracking their debt. We'll go to the debt ladder in a minute, and I've been tracking what they've been doing. And I said when there was lockdowns and all the theatres were closed and everything was closed, I was buying shares much more heavily at that point in time. And I said then how long they had cash-wise to last, and it was a long, long time, which is why I was so confident in it. And you'll see that in my previous videos, and I made my forecast, and I've got some more forecasts for you, by the way, at the end of this video, so stay tuned. But the point is, they don't need that revolving credit wheel in use anymore, so they've put that credit back to bed. That doesn't mean they can't draw on it. If they come across a good investment, they literally have that money available for them to draw on. It just means there's no interest to be paid on it right now. So here is the debt ladder, and as you can see, there's no debts due in 2022, none in 2023, and a relatively small portion in 2024 and 2025. So the bulk of it starts really in 2026. So they've got quite a long time before they have to worry about having to have debts repaid. So that's a good thing, that's reassuring, especially with the way the interest rates are now. So the key point I wanted to point out on this spreadsheet is the AFFO payout. It's only 67%. It's normal for a REIT to have a much higher payout than that, and it actually has to pay out 90% of its taxable profits by law to maintain its REIT status. And there's a reason for that. It gets tax benefits for doing that. If you want to know more about REITs, literally I have made a video explaining everything about REITs, what they must do to become a REIT, and so on and so forth. And I'll put a link to that up there now, and you can watch that video at your leisure and learn all about REITs if you don't already know what a REIT is. But yeah, the key point is that FFO is very low for a REIT, and that's one of the indicators that makes me think they're very likely to either be investing and expanding or increasing the dividend. More likely than not, both. And again here you can see the revised guidance for that funds from operations has been increased up, and you can see underneath it what the prior guidance was. So you can see they're basically, what this is saying is they're doing better now than they were expecting to do. This here shows us what the analysts' forecasts for this stock are over the next 12 months. So by September 2023, this is what the analysts are thinking. You've got 3 are giving it a high rating of $57, 3 have it as a hold and are rating it as $52.90, and then the low price target, which none of the analysts have given, apparently is $48.50. Now, given that the stock price at the moment is around $42, any one of those will see it going up. But that's what the analyst forecasts are. I'll go through my forecasts in a moment. In fact, in terms of forecasts, if we go back to this chart here, you can see the current real-time live price is $41.99 at the time I'm making this video. Now, look at the chart, and I want you to look at the similarities. So we had a big boom, and then there was a bust, okay, and it went down. Now look at that double peak, peak 1, peak 2. Then look what's happened here, peak 1, peak 2, and again a big down. Now look, it's gone up, it started to come down again. Now you're thinking, well, is that a continual down? Well, let's look at the past. I would say pattern wise, if we were to buy from a pattern, and I don't advise you ever buy from a pattern, but we are the equivalent of somewhere between here and here in the height range. And if you'd have bought here or here, would you have done well over the long term? And the answer is quite clearly yes, because even if you're buying here and it's still going down, you're still going to win over the long term. And as you can see, we've still not, even at its peaks here, regained where its peak there was. And I guarantee you now, if you watch this back in 20 years time and you pull up this same chart, these 2 peaks I'm showing you now here in 2019 and 2017 will look on the chart just like the peaks in 2008 and 2007. I guarantee it. And they will look a lot smaller because that's just the way things go. That's, if you look at any of these charts, that's how it always is. So my point is, where we are now, there's a lot of uproom in my opinion, and it's going to go up. So this dip, this last little dip here that you see here, I see that as a buying opportunity, which is exactly why I've been buying. So let me show you where I think it's going. So now let me just go through the financials with you, and then I'm going to talk about the dividends, and then I'm going to show you what return on investment you could actually expect to get, or what I expect to get from this particular investment. So here on the income statement, you can see the total revenue back used in 2012 was 318.8 million. And today it's 609.5 million in the current trailing 12 months. Now that, notice, is not the highest it's been. It was higher back in 2019 at the peak on the chart. Do you remember? But if you look, it was also higher back in 2017, 2018 on the chart, wasn't it? But look at the income in 2017, 2018. lower than it is today. Operating income, that in 2019 was 354.9 and now is 305.2. It's well up already on what it was in 2020 and in 2021, but obviously not as high as 2018 and 2019, which is when the stock price was higher. But you can see it's already partly recovered. And how long do you expect it to take to get back up? Well, go back in time to have a look. If you look in 2015, it was 274, it jumped to 317 in 2016, and then 319 in 2017. Then it went to 420, then 354. So we're essentially, if it takes that same speed, if you like, 1, 2, 3, 4 years, and we'll be back to where we were in 2019. The other interesting metric to look at here is the net income. So you can see the net income actually made a loss in 2020 due to all the lockdowns and unpaid rents. It then came back profitable again in 2021. Now, no, dividends were stopped on this particular stock in 2020, obviously due to lockdowns, and then came back lower. Again, I made videos about that. And they have now started to be increased again. And I'm going to let you know what I think they're going to be increased to in the future in a minute. But you can see the net income was 159.8 million. So that is still way back. That's somewhere between 2012 and 2013. So it's not all roses. It's not like they've fully recovered yet. We really need to see 2022, 2023 results to really get a grip on how well they've recovered. But, and this is an important but, how are they doing on the per share basis? So let's look at that. So revenue per share was 681 back in 2012, and now it's 814. What kind of magic is this, I hear you ask? Well, it's really simple. What happened when the stock price was depressed? This company, the management decided they would buy back some shares. Absolutely brilliant. So they essentially invested in themselves and bought back some shares while the share prices were depressed, meaning there were now less shares on the market, which means on a per share basis, there is more revenue and more profit, which means they are perfectly able to pay out the dividends. And that is a very important thing not to be missed. So you will notice it's 814, and at its peak in 2019, it was only 848 per share. And this is probably the single most important metric if you're a dividend investor doing this for the return that you want to pay attention to, because you want to know how much is this company making per share, what percentage of it does it pay out in dividends. If you're looking to take this as an income, then you can essentially work out how much money you're going to get paid as a dividend investor on dividends. Forget the price gain that you may get, just on the dividends we're talking there. But then if we go down and look at the dividends per share, so that's this row here, you see they're only paying out 310 in the trailing 12 months. It's currently 330, I believe, is what it's going to be forward, because they've already had an increase, but over the past 12 months it was 310. You'll notice it was 450 back in 2019. So there's a lot of headroom to come back up to there, a real lot of headroom that they could increase it to. And payout ratio, you can see what the payout ratio normally is, and don't worry about being over 100%. That is a quirk of a REIT. They can do that, it doesn't matter. So you don't need to worry too much about that. I said I'd talk about dividends, so I will. So the dividend history is here. Actually, let's talk quickly about the quant rating. So you can see quant rating, it's a strong buy from Seeking Alpha. It gives it a strong buy of 4.5. The Seeking Alpha authors give it a buy, and Wall Street has it as a hold at the moment. And you can see the monthly dividends there. If I go max, you'll see what the pattern was like. So they used to be quarterly, they increased and increased. And then I know this looks like a drop, it's actually an increase. But anyway, and just it went from quarterly to monthly. But if you was to stack 4 of these little ones on top of each other, they'd be taller than the tall ones, if that makes sense. You can see they continued increasing and increasing and increasing and increasing. And then COVID hit and they stopped for a little while, and then they came back in 2021 and they've increased in early 2022. So you can see they're currently paying 27.5 cents per share per month. So that is the monthly dividend, and you can see how it had been increasing until it stopped in 2020 due to COVID, as we just explained. So now for frankly my favourite part, I'm going to go through the forecast, let you know where I think it's going and frankly how much money I expect to make in this stock buying at today's prices, and let you know where I think it's going to be going over the next few years. Then after that, just for fun, I'm going to show you the dividend yield if the dividend increases back to where it was on today's share price, because I do find that very exciting indeed and it is a good income. So let me show you now. So you can see the current share price, $41.52. It's moving around all the time, but that's what it was when I made this slide. If you were to deposit £10,000, buy £10,000 worth, you would get dividends of $794.80. So that's a 7.94% dividend yield, almost an 8% dividend yield. That is a good high dividend, especially given that it's very likely to be increased within the next 12 months. Next March, I reckon. 2023, if you were to do that, I'm expecting the share price to be around $50 per share, which is kind of in line with what the analysts were forecasting. I think I've actually gone slightly lower than the analysts are forecasting, but I tend to do that. If you look at my previous videos, the forecasts I've made in them, it basically smashed out the water. I was right, but it passed them, basically. It did pass them. However, at this exact point in time, it's just dipped back down. So whilst it did beat where I said it would go, I hadn't forecast this particular recession and hadn't therefore forecast the share price fall, which has now happened. So hence we're now back in a buying opportunity on this particular stock, as we are with many stocks, quite honestly. But this particular stock, I think, is a buying opportunity right now. So by 2023, I think $50 per share is very, very likely. Your dividends per annum, you've only had a year's worth of dividends, so you will have made 20.42% capital gain plus 7.94% on your income. So that gives you a return of 28.36% over the year, if you include the capital gain and the dividends, obviously, if I'm right, which I don't think is too shabby. Now, if you look slightly further out, so you go out 4 years to 2025, by which time I think the revenues will be back to 2019 levels, probably higher, if I'm honest with you, but at least 2019 levels. And furthermore, remember, there's less outstanding shares, so the amount per share will be higher, unless, of course, they release more shares, which REITs do quite often to increase capital. However, this management team have been very prudent, so I would expect that they will increase things to make sure that their dividend is continually increased. And if the dividend is continually increased, the share price will by default be increased, because it can't get too high. Once a dividend gets too high, people will tend to buy it or think there's something suspect, in which case, they'll pile out of the stock. But in this instance, it's a sound company, in my opinion, again. So if we were to look out to 2025, I think there's going to be an increase in the dividend to $3.60 per share per annum. I actually think there'll be more than one, but I've only put one increase in here. I think there'll be one per year at least. They might even do two in one of the years, but I certainly will do one per year as a bare minimum, is my opinion. I think every March they'll increase the dividends. So 2023, expect a dividend increase. 2024, expect dividend increase. For the sake of this here spreadsheet, I have literally just assumed one dividend increase, and I've assumed it to be about the same size as the previous dividend increase they made. So I think therefore very realistic and conservative. Now, assuming there is just that one dividend increase and then it remains the same, you would be getting $867.05 in dividends, which of course is a 8.67% return on your initial investment. So again, fantastic. And over not quite 5 years, over the 3 years we're talking to get to 2025, in that 3-year period, you would see a capital gain of $6,859.34. So your initial capital has changed now from $10,000 up to $16,000. So that's a 68.5% gain. Plus you would have earned $2,528.90 in dividends, which is 25.29% of your capital back via dividends. So that makes an average of 31.29% per year in total, which I think you'll agree is fantastic. And that's assuming you don't reinvest the dividends and allow it to compound up, in which case it would be higher. So that is where I'm forecasting it to go. But don't go away just yet. Let's look at what might happen if they do increase the dividend yield. So if they increase the amounts of the dividends, you can see I've put the annual dividends in one column, and then I've put the percentage in the other column. Now, for comparison, in 2019, the dividends were $4.59. That's where they were on course to be. So that's where you're looking at there. So if it returns, or when it returns back to that level, on today's price, or a price of $41.52, you would get 11% yield. To get a 12% yield, or 1% per month, seeing as it's paid monthly, you would need for them to increase their dividend up to $4.99 per year, which I don't think is too far-fetched, and certainly it's something that I fully expect to happen in my lifetime. If you're interested in what price I bought them for $42.52 just last week, and then I bought another tranche at $42.35. I hope you've enjoyed this, hope you found it useful. Like I say, if you want to find out more information about EPR Properties, I have made a playlist about that. This would be a good one to put into the retirement calculator. If you've not checked out my retirement calculator, I'll put a link up there to the retirement calculator, because this yield on this would mean you don't need to have too much invested. Other than that, all I have to say is thank you so much for watching, have a nice day, and bye bye!